All right, good evening, guys. Ken at Tortoise Capital. That's the Sunday night strategy podcast. We'll be looking at some trade frames here in a second. I wanted to start with another Q&A. This is from Joe, who's been really crushing it in the chat room. We've seen some of his trades last couple of days, and he had some fresh ideas for us to consider. So he's a pretty experienced trader. He's been using Bollinger Bands. Could never really get him to work. He was using them on daily charts. He's been thinking about the standard deviation framework and the use of price bars to calculate the frog box. And I couldn't see how this was applicable to time frames above 1 and 3 minutes. I'm still playing. Oh, wait, I'm sorry. Then he started working with this idea about using the standard deviation of the width of the river. And whenever that standard deviation is less than an allowable risk, then it would seem to be an interesting time to enter. And then he put a 5-minute moving average on the moving standard deviation, and a 30-period Bollinger Band like we're using with the Red River and the lower MACD 4 seasons. There might be some additional timing there. So he's still playing with it, and he wondered what I would think about it. And it seems like there might be a fractal analysis available. Yeah, so let me shift to the chart that he sent me so we can see how he's thinking about this. There's a couple ways this connects strongly to what we're already doing. Let me get this thing going here. And oh shoot, I put the window on here. You can't see his his indicators over here. I had that window hiding it. But what he's got is basically in this lower section down here. Here's the standard 4 seasons of MACD. I would say for Joe, you're using a exponential moving average, whereas I use a simple one. But I don't think that makes that much of a difference. And so what he's got is a standard deviation on the river width, and he's showing that as a moving indicator, and then he's got he has a SMA 5 on that, which is like the lagging. So when this thing, the idea is when it gets to a minimum, that's going to show you the narrowest river width. And then you have the idea would be that there's a 5-period moving average of that. And that when this gets below, and then a Bollinger Band mean on that. And so if that's the like the equivalent of the Red River, that when the Bollinger Band mean starts to expand, like you would see here, like you're at a peak or a minimum pinch of the river, that's what you're seeing here. Then when you start seeing new volatility coming in, it's because there's a difference in the buyers and sellers balance of power in there, that there's now suddenly, instead of just a quiet compression of volatility, you're starting to get expansion, and that should be a reflection of new money or new energy flowing in. So the first thing you would see would be a crossing of that 5-period moving average, and then you would see it cross that river. And so this is very much like the RLXD, only now instead of just pure price, you're doing this on volatility. And what you're catching is that the winter of volatility is the absence of a fight. So there's not a an aggressive fight between the buyers and sellers. It's the absence of that contention. And so now that new energy comes in, and then you'd see it break across and across the river. And that's kind of what happens right here. You would see from the change occurs right here. You see he's got that highlighted in that box, that after this little range, this volatility compression, you see how the amplitude's getting smaller, and you see that the Bollinger Bands are starting to compress. Well, when you get this breakout, that's going to correlate with this. You're actually seeing a Z3 pinch breakout, and you can see that Z3 pinch starting to change in the width of this box. It went from very, very pinched and narrow to the beginning of range expansion. And then shortly thereafter, you'll see the Bollinger Bands respond. This should be a little bit quicker down here because you're only crossing a 5-period moving average, and it takes some time for the price to actually break out. And then you'll see another one of these here where the directionality was here, and instead of continuing down, it starts getting this sideways chop, and now you're seeing the Bollinger Bands pinch, and you're getting a narrow width of the river. And in his box, that is highlighted that it has now achieved a local minimum well out of that river volatility. Then it crosses its own 5-period moving average, and then by about here, you should see it start. That's where the breakdown, now it's telling you that's a real breakdown. So the principles are sound, and what this is really looking at is the idea of seasonality of volatility. And so the insight is a good one. It's like the 1 minute rest in between 3-minute rounds in boxing. So in boxing, for those 3 minutes, you got guys beating the crap out of each other. And so some guys are winning, and then its momentum shifts, and so you're getting a lot of activity, and then it gets into that 1 minute rest period in between. So the absence of volatility now becomes the alert. Then after a period of time, the 1 minute rest where volatility has compressed, the next thing that happens is the action goes again. I don't know which direction it's going to be or who's going to take charge, but that period of relative quietude is followed by a period of amplitude or increased volatility in some direction, and that quite usually becomes some kind of directional move. So the principles are really sound. So what I want to show here is the connection of that to a couple different ways that we use this, right? So let me just call that the seasonality of volatility, right? And that wave of volatility has smooth wave characteristics, the same way that the RL10 smooths out our price. When you start tracking the expansion of the Z3 lines, and then the compression of the Z3 lines, you see that almost looks like that's going to look like like an EKG. And so these moments of peak volatility are often characterized by, the culmination of a move. So you might have had some move that was chunking around here, and then you had some kind of breakout, and then it peaks, and then it's going to come back to whatever that Bollinger Band mean was. That might even be slightly up, because this price action up tends to pull that Bollinger Band mean up a little bit, and then you get that reversion back to the mean. And that's what happens when you got this compression. Well, once you get to that peak moment, which we're always on the lookout for those two dragon horns way up there past Z2, and then you see that thing rolling over, well, then that price action starts to look like this. So the initial wave, we know from the peak, is tradable back to the Bollinger Band mean. But once this thing starts getting all compressed in here, now what you end up having is a sideways quiet channel, and that's not tradable until this gets to a Z3 pinch, when this is so quiet that now the breakouts in either direction become tradable once more. So we go from a period of quietude, tradable, tradable, not tradable, tradable. And this is reflecting the seasonality of volatility. Now, the width of the Bollinger Band itself, so BB width, is found in a indicator called %B. So if you read Bollinger on Bollinger Bands, that's his book on the subject. It's very good. He likes using the 20 period, and that's the default. He uses a 20 period and a 2 standard deviation to establish, put this in brown, I guess. So his little Bollinger Band things look like this. And so this is like 20 and 2, and then there's some Bollinger Band mean in the middle. And he has different ones where, you wait for a breakout of that band, and then that becomes the thing. And then a re-entry of that band signals a return to normal, and that your outsized directional moves are out here. I use 30 and 1, and then 2 and 3, because I like the statistical significance of 30 rather than 20, and I like to have different dashboard on my screen than other people, so that I can see things that they're not seeing. And so the way I do it has that BB mean in the middle, which we know is a Z-score of 0. And then these outer envelopes at Z minus 3 to Z plus 3. Plus or minus 2, and then plus or minus 1, with us treating that between plus 1 and minus 1, let's say minus 2, this is what we're calling the river. And that's where you get chewed up, where the crocodiles are. So if you're trying to trade, inside this range, you're often getting chewed up, especially after a strong move. When there's been a strong directional move and it starts to recover, at some point when this starts narrowing in this range, the moves are declining, so you get chewed up inside the river. But that first breakout of the river, and if this was a Z3 pinch in here, that a breakout above the Z3 lines becomes tradable on that next range expansion, which you'll see the Bollinger Band means expanding, right? So Joe's question really is, his insight is there something about an analysis of the width of the river, because now you can see that thing is expanding. And remember that whether you're measuring from Z3 to Z3 or Z1 to Z minus 1, these are all built on standard deviation blocks. And so when that volatility is expanding, each block is getting bigger than its previous one, but the relationship between the size of the blocks is standard. So whether you're measuring the distance from Z3 to Z minus 3, or just the size of one of these standard deviation blocks, whether it is small, normal, or large compared to a 30 period look back or a 180 period look back, like I like to use, it doesn't matter whether you're measuring Z3 to Z3 or Z1 to Z1. It is the size of the box compared to previous boxes that matters. So when you look at, let me put a new one on here for a second, because I want to talk about the application now. So I want to talk now about market classification. And the seasonality of volatility. Seasonality of volatility for daily charts plus swing trading. So if you look at our market classification system, over on this side we have bull, sideways, and bear. So this is price action, and across the top we have volatile, normal, and quiet. So the piece I want to talk about is the difference between volatile, normal, and quiet. Maybe I should draw it this way. Volatile, normal, and quiet. Just to review, the bull, sideways, and bear is price relative to the 200 DMA. And so when the 200, that simple moving average is here, we just put that 2% band, and then if price is within that, is within 2%, then it is sideways. But if it's more than 2, then it's bull, and if it's less than 2, it's bear. And that's how you get this dimension, whether it's bull, sideways, or bear. The volatility, though, is computed by today's ATR percentage compared to last 100 days. There's nothing magic about 100 days, except that was the first number that I picked when I was doing this study, and it worked out so nicely. I've just kept it that way and have accepted it because what I really thought was the minimum number that I would have to use as a look back to classify today's ATR percentage would be 30 in order to have statistical significance. And I might go out as far as 180 so that I could have a large 180. And so that I could have a large study, I just went with 100 because it was like splitting the difference between 30 and 180. So the way I compute that is I take today's ATR 14. So that looks back 14 days, and then divide it by price to come up with an ATR percentage. And what that lets me do is use the volatility as a percentage of today's price in order to normalize it as I look back 100 days, so that I can account for the difference in price. And the reason you got to account for the difference in price is because today, if the price is 50 and the ATR is 2, then that means it's moving 4% of today's price as part of a normal range, right? So it's moving 4% of today's price. Well, what happens if 100 days later that thing has gone from $50 in price and now it's at $100 in price, but the ATR is still 2? Now the price is 100 and ATR is 2, and you might say, oh, well, 2 is equal to 2. The volatility hasn't changed, but it actually has, because now it's only moving 2% of today's price. So the even when price goes up, but if that's price, and if the ATR in this case would be flatlined at 2 all the way across, you might look at this and say, oh, volatility isn't changing because the ATR has remained at 2 all the way through there. But in fact, because price is going up, the volatility is actually declining. It is now half as volatile as it was when it was at 50. So this is a case where the indicator creates a false impression in your mind because you haven't taken into account the relationship between volatility and price. And in fact, what would be even worse was if this thing had gone from 2 to 3 over time, you might be thinking, volatility is increasing because ATR went from 2 to 3, but because price went up, it's actually less because it's only 3%, whereas it was 4% over here. So the rising ATR creates an even further false impression that volatility is increasing when in fact it's decreasing. And so you don't even know if it's increasing or decreasing until you do the math to compare it to price. Because if this thing had stayed constant at 50 of price all the way through those 100 days, but volatility raises from 2 to 3, in fact, volatility is increasing. So you can't judge what volatility is doing over the long term just by looking at ATR. You have to look at ATR percentage in order to come to a fair appreciation of what volatility is actually doing. Okay, so I wanted to say that. That's why we use ATR percentage. All right, so now to compute ATR percentage 100, what I have to do is this. To compute today's ATR, we have to look at we're looking back at the last 14 days, and math is performed, and it takes into account the intraday range, but also the size and direction of the gap, and then that allows you the average true range, incorporates the information of the volatility of the gap, and now you come up with a number. So that's going to equal some number. So for today, at day 0, I had to go back 14 days. So now if I want to compute the last 100 days of ATR percentage, I have to go back a day and 14 days. And so I'm going back 100 days plus the previous 13 days in order to come up with the ATR percentage of what it was 100 days ago, and then 99, and 98, and 97. So I have to do that 100 calculations to come up with a list of ATR percentages each of those days. So now I have a set of 100 ATR percentages from the last 100 days. So now what I do is I array those as max, min, average. So I find the largest score to the smallest score, and I find the average score, and then I compute the standard deviation of that 100 data points, and then that becomes plus or minus 1, plus 1 and minus 1 standard deviation. And we know from statistics that average plus or minus 1 will give us about 2/3 of the data. And then about 1/6 of the data resides between plus 1 out to the max and from minus 1 down to the min. So there's about 1/6 of the data out there. Okay. So now we've computed the last 100 days, and we've come up with this this array from maximum to minimum, and we have this normal Z-score ladder. So now we compute the ATR percentage of day 0. So what was today's ATR percentage? And it is some number. So when we find today's ATR percentage, we can then come up and plug it into this score, and we say, here it is right here. So if that's where today's ATR percentage was, we could say that this thing is volatile because it is more than 1 standard deviation above the last 100 days average plus or minus 1, right? So it has a Z-score greater than 1. So that's what makes it volatile. So when you look, if that's volatile, when you look at the S&P on that little daily chart, today it happens to be bullish because price is more than 2% above the 200-day moving average, plus it's volatile, so that makes it here. Now, what we know from our studies of S&P volatility is that when today is bullish volatile, or normal, or quiet, or sideways quiet, so when it's in one of those 4 categories, tomorrow, on average, was up. And if it was sideways volatile or sideways normal, then tomorrow, on average, was flat. But if it was any bear volatile, normal, or quiet, tomorrow on average was down. Well, so this is a case of using the seasonality of volatility to give us some insights about what we could expect to be least surprising tomorrow, up, sideways, or down, on the basis of this combination of price and volatility. And the important point to note there is that increasing or a highly volatile reading by itself does not give you a directional bias. All you know is that this thing has been making large moves in either direction. You just don't know which way. If you knew that it was bearish, then you might not be surprised if there was a big move down, but you can see big moves up on dead cat bounces. Now, what's interesting, though, is that when you look at the pure quietude, what you actually get is when it's quiet, 2/3 of the time, that move is up, and only 1/3 of and only under one condition, when it's bearish, is it down. So the seasonality of volatility really does matter, but you really want to know something about this price. You want to know what the previous price action was to give you a deeper insight into directionality. But the good news is that the act of being in a quiet mode, especially when it is abnormally quiet, is a very favorable thing, and that is fractal, whether you're looking at 1 minute and 3 minute or at daily charts or even longer. So there's something very important that when you see in this, the way I describe it, the Z3 lines are pinching, that Z3 pinch. Intraday, we're using the size of the daily frog box to determine, here's a Z3 pinch because the Z3 is less than a frog box. That tells you that the intraday price has compressed so much that the intraday move out of that box could really be powerful, because we know that on any given day, the intraday move can go 2 or 3 frog boxes in either direction from this moment of pinch. So the Z3 pinch condition intraday tells you that the relative width of the Z3 lines are important. Now, I would also say that if you just use the volatility element of the sideways quiet channel, or of the market classification, the TC2000 bundle has this structure built in, not just for SPY, but for all the symbols on daily charts. But here's the beauty of that thing. You can substitute the daily chart for 1 minute, 3 minute, 5 minute, 10 minute, whatever time period you want, and you can actually classify the price condition with price relative to the 200 period moving average, not just the daily, and the volatility classification compared to the last 100 periods of look back, not just the daily. And so that's where you really get the fractal power of this combination of price and volatility. And the power of the TC2000 bundle is you can do that for any symbol on any time frame, and you get a really powerful fractal insight that gives you actionable information on any time period. So, in conclusion, Jim's insights about paying a special attention when you see volatility has collapsed to an abnormal condition, and he was defining it as pinched to less than some measurable risk box, and was tracking it in the same way that we do the 4 seasons. That's absolutely a valid way to do it. But you can also get that same insight from market classification on any time frame, and you can look at the Z3 pinch lines on any time frame, any classification, and then the breakouts from those moves follow the normal tradable patterns of hybrid trading. But it gives you a sense of timing that when you see those things pinching and it gets to a certain level, you want to think of that as a coiled spring, and it's locked in, or like a mouse trap that's ready to go snap in either direction. So I wanted to point out that Jim has encountered this and thought his way through it with some genuine original thinking, and it connects very strongly to the ways that we look at this stuff. Okay, so that's what I wanted to say about that. And we've talked about that in a couple different places in the hybrid workshop, but it always bears repeating, because I think it's just like volatility is seasonal, I think these lessons are seasonal too in some ways, and it doesn't hurt us to look at them with a fresh set of eyes. So hopefully you found that helpful. I didn't realize it was going to be a 45-minute lesson and that you're really here for the trade frames, but I felt like this was worth saying. All right, let's get to the trade frames. Caterpillar, I like this. I like the big, like the big strong move up. Big strong move up, orderly pullback, and then a 1, 2, 3 higher lows with a nice tight risk box. And we had the entry and the close. So it was strong intraday and closed near the fair price. And any breakout from 172 should test this. So I like that. I like this reversal. There's enough. There's 2 risk boxes to the downside. So if you wanted to try that on the short side, you could. And that looks very tradable to me in Caterpillar. I think that that works very well. A break, second position on a break of the Bollinger Band mean, which is also a break of the southern skin of the dragon. And third position, if it breaks below the belly of the dragon and the PSAR, in a fourth position on the belly of the RL10 and the original PSAR, and you'd be in great shape. So that would give you, you'd have 4 positions on the by the time it really collapsed, and then that would get you back. Your next target would be way back here at 148, and you'd have 4 positions going, and that's good. I like this one. Second position upon a breakout of, it's really a combination of Z1 and the all-time high, 176. And then the Z3 max excursion would be confirmation that this thing really had broken through an extraordinary price level, and then you'd want to have 3 positions on by the time that goes to 200 with no resistance overhead. So great shape on that one. You'll see Honeywell has basically kind of the same pattern, but this is even better. Honeywell's even better because the size of the sell-off was less. From here, the size of the sell-off to here was even less than Caterpillar. Held a pretty tight recovery, held support at the upper skin of the dragon. So you're playing a 1-day low. Really, this thing will, if it breaks out here, that's the urge to buy. And then the second position here at 210 in great shape. I'm reluctant to short this one right here. But I think you either have to short it here or here to be able to get all the way back to 175. But, you're looking at a move from 200 to 175, and that's 25 points. It's hard to see Honeywell failing that much. I mean, even from in here, this was the worst downward move that it had. That was like, about 175 to 160 minus 15. So I suppose it could happen. But even that was an orderly move just to the bottom of the river. And then it moved to the top of the river pretty nice. And thus the breakout was key. This one, though, has the range expansion. So I think if you were going to be committed to Honeywell as a short, first realize that Honeywell has been better than the Qs and better than XLK. So you're shorting the strongest stock in the strongest sector, or one of the strongest stocks. And they lack that sort of big fat target on their head that like Facebook, Amazon, and the other ones have really had painted on them. So these are guys that are quietly getting it done. So on that basis, they're not my first choice as a short side target. But if you were going to do it just on the numbers, I think you either have to get it here, but I think I'd wait for 195 because then you could get to 185 and that gives you minus 10 and you only got a $5 risk. There's your two shorts, and then the third one to the Bollinger Band mean. But there was so much indecision in here that I wouldn't take this as the short. I think I'd wait for it to break below this whole piece here. I think I'd be short at 195. That's what I want to say on that one. Otherwise, a good candidate in both directions. Coca-Cola is basically, it's going to be the same logic. I think I would wait for 52.30 rather than 52.85 to be short, and then I'd play for my short as the width of the dragon back to the Bollinger Band mean. So that's the same picture. Oh, let me get this. This one didn't completely download. Yeah, that's good. United Health, that's even better. I like this one. So what makes United Health more interesting than even than the other ones is that it's already had one big move up and then the big sharp move down, but it's had an 8-day really tight box inside here, and it terminated in the tiniest little doji. And in that time, you notice the distance to the Bollinger Band mean has come up, and the dragon has moved up. So now we're right on the edge of that support level. So now if it's had 5 days and it has failed to follow through. So now if this collapses, now it's a quick shot here, and that's, one risk box, 1, 2 units of reward, 3 to the Bollinger Band mean. And healthcare is very vulnerable to policy choices and pronouncements by the Biden administration about either supporting or denying healthcare for all. So this is, I think, just waiting to see which Biden emerges from the cellar and waiting for Trump to say something before this really, it's like it's just marking time. So I think you could start with that really tight risk, like a seed, and off it goes. I really like that trade frame, that one. And because it's not tech, it has its own dynamic, and it won't get swept up by the market as much as it would by the perception of healthcare in terms of future policy. So I like that one. Walgreens. Now this one's interesting for a different reason. So Walgreens has been lagging behind everything in the Dow, just getting smashed until lately. So this has been one of the more reliable shorts in the Dow when the Dow was recovering from the big sell-off. Walgreens was not, and the size of this sell-off was bigger than the rest of the market. So this went from 44, to 33, and that's a minus 25%. And so this collapsing dragon was just horrible. Now, there was a small SSC available, where there was one here that lost. The CATA 2, so that's an SSC. CATA 2 is this entry that offered a fractional gain, but when that collapsed, it was a big collapse. So Walgreens has a lot of negative energy in this thing, but this breakout has occurred. It gave this amazing run up, a harsh sell-off, and then a harsh recovery. So you're getting a look at max volatility here. Max volatility in Walgreens. Whereas the size of the volatility here in this period was pretty small. The daily ranges were small. These daily ranges are large. So this is giving you a short-term intraday trader. This was not always the case through here. This was a really good swing trade on the downside, but not a very good intraday trader. But now the size of this volatility in here is making this a good intraday trader. Because look at the directionality. It went from 41 to 43 in a straight shot, and that's a 5% intraday move when the market itself is only giving you a 2% average range. So this thing is 2.5 times the volatility of the market, and it's combined with very directional, and it closed near the very top of a breakout move, which is already above these key price levels. So now the next thing that's in range are these two resistance levels at 40, 45, and 46. So a breakout from here with like a dollar stop would give you a really nice move. Conversely, the downside is easy to believe in because of all this, pain and suffering that you see. The last 3 big waves have been down. So I say all that just to say that I really think I think the risk box gives you a nice directional move in here, but I think I would pick half that box as my risk. So if it broke out to the upside, I'd start my risk here and trail. But if it broke down out of this, I could intraday trade that here with about a 25-cent initial risk, and then start adding these swing positions on the downside, and I'd be adding swing positions to the upside here, paid for with market's money. The downside is easier for me to believe in just because of all this stuff was down that entire time frame, and this is kind of the aberration, and it's got huge volatility. So to me, the downside is much easier to believe in. But Walgreens is now in play. All right, so now we have Cisco. Cisco has just been breaking people's hearts. Boy. Intraday only on this one to the upside. I am not believing the swing trade to the upside on this one at all because it's been so horrible. But this price action was able to leave this behind and all of this behind. And so any breakout from here is really closing this gap, which is then closing this gap. So this thing is on the verge of making a run up to 47 and leaving all of this crap, this entire crap behind. So that's what that one day. But I would only do this with an intraday and then keep 1/5 of what I earned on the intraday trade with a really tight stop for that swing trade. So if I was going to swing trade that one, I think I'd have at least a $2 stop. Let's take a look at that again on a cleaner sheet. So if this broke out, then I should have a hybrid frog kind of an entry with maybe a 25-cent risk. And then if it broke above this, you're holding $1.40. Sorry, you're holding $1.40 on a 25-cent risk. So you'd be holding about a 6R execution risk and then you could take one of those. You could bank 5 and then keep one on as a swing trade, and then I would keep that risk where the original risk was, and then let that grow. And then if it got above 44, I would be adding a second swing position. But the downside is much easier to believe, because if it breaks down here, it's coming back into the river, then quickly to the Bollinger Band mean, then out of the dragon, then to the belly of the dragon, and now it looks like this. So that would actually be, I would start my swing trade right from there upon that breakdown. So Cisco is offering really strong ideas in either direction, but they're not symmetrical. The upside is really a rush to reclaim value, but the downside is just reinforcement of the last 2 months of just 3 months of absolute misery for Cisco. So I like it in both directions, but for different reasons. The Dow is just standing by. This is just straightforward, almost like Honeywell. It's held the support level, closed strongly, breakout to the upside, play it in the usual way with the chain trading and the hybrid frog, and the trade frame looks solid. Brazil the same way. Just start with a hybrid frog, keep 1/5 if it breaks out of the yellow box. I think we're in good shape on that one. Start it, both of those with the intraday first. GE is interesting, like has some of the qualities of Cisco in the fact that it has really rejected that long, horrible slide. Let's take a look at this one. This is actually genuinely evidence of a turnaround. So in one way, what we saw with Cisco was that it had a nice run, and then it got smashed down, and then it just kept falling and falling and falling. And then this was the first recovery move in Cisco that got above the previous support levels. And we were wondering, well, maybe it really can go back up to the previous price levels. So this is where Cisco was in its life cycle. But GE is 2 or 3 weeks ahead of that. It's already put in 1, pause, 2, pause, 3, and postured for a 4th one. So GE is actually manifesting what we were hoping to see in the Cisco long, looking forward. We've already seen that in GE. So that's why the upside in Cisco is interesting as a return to its previous height. And that's kind of what those gains look like. Leg 1, leg 2, and the possibility of leg 3. So any breakout above here at $9.25 with about a 25-cent risk is really no risk at all, because this thing is already above the previous swing high. And this move here has negated all of this weakness in selling, and now it feels more like it's connected to this first move up. Now it's the second leg up on this long term. So this is really good to the upside. I would wait to see a breakdown below here in order to get back to the Bollinger Band mean, because I'm taking that as very strong support. You might tentatively get short here, but you got to be short by there in GE. So good find, good pick. Last one, U.S. Steel. This looks, this is actually intermediate between Cisco and GE in terms of the life cycle. So this will be cool. So we saw on GE where it is already at or above the previous high with some legs behind it. U.S. Steel, on the other hand, is locked into this support level right here. It hasn't breached that price yet. In fact, where it did, it has come back in. So I'm ready to respect it on the way up, but the downside on U.S. Steel when it cracks is so compelling after these big run-ups beyond Z3 and beyond Z2. These big run-ups get punished. So this time the punishment didn't really fail out of the dragon, so this really feels like this is here to stay and going to be good. But you also have to respect a breakdown below psychologically important price level of 10, second position, third position, fourth position. And then if it breaks out of here, you'd have 5 positions short coming back to the next solid support down around 7.25. So it's only a couple bucks, but remember, we're only talking about $10. That's a 20% sell-off. So U.S. Steel remains as a high pry. So if we think about this in terms of life cycle, we had Cisco, U.S. Steel, and GE. GE had already given us 2 strong legs up and was well above the previous high. So that's what a fully recovered and moving out symbol looks like. Cisco had only just come out and was getting ready to close the 2 gaps from the previous sell-off. It had been here, had 2 big gap down, and now it's poised to recover those. U.S. Steel has come out of this and just gotten back to the support level where it's locked in. So this is really the critical state in either direction that could be great. So that's what I want to say about that. All right, so we're an hour and a half into this thing. Need to get you some time to prepare. Good array of choices in the room, and we'll be ready for tomorrow. Hope you enjoyed the volatility piece, and I wanted to front load that while our brains were still fresh. But now it's time to get out there and walk them doggies. Take good care, guys. We will see you tomorrow. The Patreon index link of the videos is caught up to date. I'll get this one, with the exception of this one, I'll get this one added tonight, and then we'll be back on task. Okay? Take good care.